Hello friends, welcome. Friends, RBI is going to start its MPC, the Monetary Policy Committee meeting on Friday. And you can see this headline, which Economic Times has just published today, that is on 4th of February, which says that RBI seen cutting rates for the first time since May 2020. So the policy rate currently RBI is holding at 6.25%, everybody knows. And this is going to be cut by 25 basis point. That is what the speculation is, right? So government, you might already see in the budget, and in the budget, one of a very important item is interest payments. Now, if you look at this, I just zoom in a bit so that you can see this interest payments. Now, interest payments for the budgetary estimate for FY26 is 12.76 lakhs crores. So, if you look at this GOI accounts main cumulative, let me just zoom out a bit so that to see the chart properly. So, this is the Government of India's accounts dashboard, which I have uploaded in my website, and I can basically take a yearly time scale, which will give a better picture. So, you can see that the interest payments have been steadily rising, right? You can see that the interest payments have been steadily rising. Now it is 12.76%, 12.76 lakh crores. So if I do a budgetary estimate as a percentage of GDP, let's see what the number comes out to be. So the number as far as interest payment is, it is already one of the highest, you see, for all times, for all the years from FY18 till FY26. If I go down below, you can see that it is highest, 3.58% of the GDP, highest in all the years that we are seeing in the dashboard. So which means that apart from triggering the economy, the main concern of the government is to bring down its interest payment. And that's why policy rate cut is absolutely essential for the government, right? We can clearly see that apart from liquidity in the market, driving the economy towards growth, key part is interest payment outflow, right? Which is a very significant part. Now, friends, what I have done is, since the policy rate, reduction of policy rate is closely linked with inflation and expected inflation. These are the two important metrics in which the policy rates are linked towards, because it gives an indication to the market about what the government thinks about future inflation, because policy rates are always tweaked up and down to manage inflation, which is the direct objective of policy rate tweaking, and it does so by managing liquidity. That is how the whole thing is structured, and that is the main driver of policy rate increase, because higher the policy rates, the interest rates become higher, and therefore the availability of funds for the industry is going to become dearer, and therefore the liquidity is going to shrink. And if you bring down the policy rate, the funds are going to become cheaper, the liquidity is going to increase. But there is a direct impact on this is on interest payment obligation of the government, because more the interest that the government has to pay, the higher the policy rate, the more the interest the government has to pay, especially for short-term instruments, not long-term instruments, and I'll explain to you in the next chart. So let's go to the next chart, which is going to be very interesting. So I have taken a lot of pain to create these charts, my friends, right? Because this is an overlap of three different components. So let me zoom out for you to understand what is going on, because this is a very important chart. It will give you three important dimensions in one single snapshot. One is the repo rates, which is here. Then we have the inflation, which is here. And then we have the various bond rates for various duration from 1 year to 20 years here. So what you see? You see a direct overlap of all the rates, because the bond rates are indicative of, the long-term bond rates are indicative of expected inflation. The short-term bond rates are directly influenced by policy rate. You can clearly see, and I'll go one by one to kind of take you through this chart. And then we have the inflation here. And what I've done, friends, I actually have given you control here to overlap different types of inflation. For example, you can choose to superimpose, let's say, housing, right? On top of this, you can choose to superimpose miscellaneous. You can choose to superimpose food and beverages, and you can choose to import anything. And then there is another control here. You can choose to pick rural, then you can choose to pick urban, and so different types of inflation that you can choose and superimpose on this to get a feel as to where inflation stands and whether the policy rates actually have been able to contain inflation, and what would be the likely of future inflation, which is going to be clearly spelled out by the bond rates, especially the 10-year bond rate, which is giving a indication of expected inflation. Because there are many questions you can ask the market, what is the expected inflation? But the bond rates is a very good reflection of expected inflation, which is the 10-year bond rate and higher bond rate, because over a long period of time, if you are expecting a higher inflation, nobody is going to invest in a bond which is of lower yield, because that is going to give you a suboptimal instrument. You are going to lose money. So people, depending upon their expected inflation over a long period of time, make investment in bond yields, and therefore the bond prices will fluctuate based on the expected inflation. That's why the 10-year bond rate is very, very crucial. As regards 1 year, 2 year, 3 year bond rate, these are driven by the policy repo rates. This is the fundamental principle one needs to understand, and that's why if you see here, when the policy rates are lower, held lower at 4%, you can see that the lower bond instruments are green. Can you see that? So this chart has got one more control here. Apart from having these controls which I have already mentioned here, you can choose month, year and quarter. You can enter the number of time units, from a vertical point of view, you want to see, and then you can shift the chart by an amount of time units. For example, if I enter 10, then what will happen? The whole chart is going to go down by 10 units, 10 time units. You see, all this have come up. So if you have this access to this chart, you can play with it and you can basically look at what happened in past, starting from 2014, and how the overall picture looks now, right? Because primary aim is what? To control the expected inflation. This, not only this inflation, whatever you see right now. So let me just take the combined inflation. So the combined inflation is still held very high, 5.2%, 5.0. There was a brief aberration of 3.7 and 3.6, but it's still held very high. And especially the problem is basically with the food and beverages inflation, which is much higher than general index. So it's still held very high. So given this situation that we are in, where there is a huge problem of inflation, the unfinished work by RBI, does it make any sense for RBI to tweak this rate, repo rate? Because would it not give a wrong indication to the market that the inflation going forward is going to, maybe it is not going to resonate with the market sentiment of higher inflation, right? So there has to be a clear-cut understanding that the market is seeing a lower inflation by looking at the 10-year bond rate. Then only the policy rate can be, because policy rate is always an instrument which is like a medicine to contain the disease when the disease actually appear. It is not to be administered in advance before the disease. Like for example, if there is a infection that you have, then only you give antibiotic. You don't give antibiotic even before the infection appears. So this is the same thing. The policy rates are always administered when they see that there is a problem which is happening, and you will always find that there is a phase lag between the policy rates. So in order to give you that flavor, let me shift this by 25 units. Because this is a monthly time scale, 25. Let me put it 25. So when you see 25 units, you will always find that, look at this situation. Look at here, the inflation was lower because the policy rates were held high. Then the inflation started going down because you adjusted the liquidity. Then what happened, that the inflation basically started going up. These are all up. There were few aberration of lower inflation. The policy rates were still held lower. And then the inflation shot up. And if I make it 0, you will see that the inflation went very high because these numbers were very, very high, and therefore it gives you a picture that these are low, but these are high. But we have been holding policy rates high, and there is no indication that this is falling at the level of 4 to 2%, which is the window period which RBI manages. And the expected bond rate, the inflation is still held very high. But strangely, one thing I basically find very strange here, if you look at the bond rates, except for few years, when the RBI policy rates are held very high, in general you will find the bond rates are typically higher within the range of 6.5 to 7%. And to give you a flavor, let me just push the chart by 50 units, and you will find that whenever the policy rates are held low, the bond rates are also reasonably lower, right? And whenever the policy rates are held high, the 10-year bond rates are held high. Except for few years, for example, here the policy rates are basically 6.25, here it was 6.5, then it basically fluctuated between 6 and 7%. But if you look at this, here the bond rates are slightly between 6.5 to. So I don't know how much these numbers are accurate, because it gives me a very strange feeling, let me tell you. If you look at the US market, these bond rates are a great indicator of expected inflation. But I don't find these changing significantly in India. I don't know why. It's a very strange situation, right? Because these bond rates should fluctuate vehemently if the inflation, suppose let's say if the inflation has fallen down to a very low level, these bond rates should there should be a phase lag, but still it should follow, with a phase lag. But it has never gone to a level of 2%, 3%, 4%. I have never seen that. It is always held very high. So maybe the Indian consumer does not feel, or Indian typically a businessman who is investing in bonds, they never feel that the India is going to see inflation rates lower at 2 to 4% on a perpetual basis. So he's always prepared for higher inflation. Therefore, the bond rates are always held high. That could be one of the reasons. Or the second reason could be that these numbers may not be accurately calculated. These may not be the real inflation which the market is seeing, because these are for generic population. If you go to the Ministry of Statistics website, you will see that they maintain a document of household income. So they are capturing the household income for various groups of population, and typically those incomes are very, very low, and all the investment or consumption basket, which they segment the household which are making different type of consumptions, for which on the basis of which the weights of these general index is decided. Those are kind of tuned towards the average population, which are heavily weighted towards a population class with a very low income. And investment in bonds are typically done by a population class which have reasonable income, not normal human beings. Those people who do not have disposable income, they will not make investment. So there is a level of dyssynergy. We have to look into it. So what I am doing, I am not an economist. I just play with data. My skill, which I have developed over a period of time, is to play with data. So what I have done is, I have many such chart in my website, which will give you an ability to play with this data in this manner, so that you can see what is going on, and whether whatever policy announcements are being made, is it really reflecting the objective of those policy instrument changes or not. It is not just about growth. It is not just about managing government outflow as far as the interest payment is concerned. It is ensuring that our currency does not devalue, because if our currency devalues, then you cannot maintain a stable rupee to dollar value over a long period of time. Like for example, if you see the dollar is appreciating, the rupee is depreciating. Primary reason for that is, over a long period of time, our currency and the US currency are diverging in value. That's why the dollar is appreciating and our currency is depreciating, and that's why holding inflation rate, the real inflation rate, is crucial. So friends, I will not go beyond that, because I may not be an expert in this subject, but what I understand is data. I will put this data in form which you can see and understand. and play with, and then you can make your own conclusion. So that's the end of this video, friends, and I hope that you have liked this video. You can get the access to this chart by going to my website, and you can play around, and there are many other charts like that. You can play around with them and you can make your own conclusion. Thank you for your time. I'll come back with a new video next time.